The housing market has never been this unaffordable. At least that's according to Business Insider, who just put out an article titled "The Housing Market Has Never Been This Unaffordable for Buyers." And the reason why, according to Business Insider, is because number one, interest rates have skyrocketed so much, and number two, prices for homes have not come down. Let me read you a sentence from this article. It says that Americans looking for a new home are facing the least affordable market ever, according to new data from the Mortgage Bankers Association. And the reason why is because in April of 2023, and I know this is coming out in June, but in April of 2023, the data was released that the unaffordability index for buying a home has reached the highest levels ever, meaning it is the most unaffordable market for housing that this data has ever been recorded for. Now, why is this significant? Well, if you go back to the article, they talk about why mortgage rates and home prices are so significant to understand right now. What it says is that this index hit a new record because not only have interest rates not retreated from the high sixes, and the typical application amount has jumped all faster than incomes have grown. In other words, people's incomes are rising, but they're not rising fast enough to keep up with the growing home prices, and they're definitely not rising fast enough to keep up with mortgage payments as now interest rates are rising. They then talked about median monthly payments on homes. And take a look at this. They said that the national median mortgage payment went from $2,093 a month to $2,112 a month to April, and this is according to the Mortgage Bankers Association. Meaning, mortgage payments not only are rising month over month, but we've been seeing mortgage payments, the average or median monthly mortgage payment, grow month over month over month, year after year after year, and they're rising significantly faster than wages. This is where now the Mortgage Bankers Association says, well, something's got to give. But what they say has got to give is mortgage rates, not the housing market. But I'm going to get to that in just a little bit, but I want to take a look at numbers, because what they talk about with mortgage rates is very interesting as to how fast mortgage prices have gone up. When the Federal Reserve Bank began raising interest rates in 2022, mortgage rates on a 30-year fixed rate loan more than doubled from 3% to above 7%, which means if you were to borrow $400,000 just a couple of years ago, not even a couple of years ago, at 3%, which is what a 30-year fixed rate mortgage was, you were paying $1,650 a month on that money that you're borrowing. Today, if you wanted to borrow $400,000 to buy that home, you're not getting it for a 3% mortgage. You're going to pay 7%, if not a little bit more, but you're going to pay 7%, which means you're not paying $1,650. Now you're paying about $2,660 a month to borrow the same amount of money. But here's the kicker. You can't buy the same home by borrowing $400,000. You're going to have to borrow $430,000 to go out and buy the same home as before. So not only do you have to pay more money to borrow that money to buy that home, but you need more dollars in order to borrow that home. And this is where the Mortgage Bankers Association is saying, well, yeah, people have to pay way more to buy a home, but wages are not growing anywhere near fast enough. Now, we've done full deep dives into the housing market on Market Briefs, which is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so, because we keep you posted on what's going on with the housing market like this, the Fed, the stock market, the economy, and everything in between. So if you want to stay up to date on what's happening, when it's happening, I highly recommend you join Market Briefs. It's a free newsletter you can read every morning, and you can read in less than 5 minutes every morning. So if you haven't read Market Briefs, I got the link to how you can join for free down in the description below. But this is where now it gets even more interesting, because the information you get from the Mortgage Bankers Association now starts to deviate a little bit from what we've seen happening in the past. You have a lot of people with predictions as to what's going to be coming in the housing market and what's going to turn this around. And what you hear from the Mortgage Bankers Association is that the problem is going to be fixed because mortgage rates are naturally going to fall. Take a look. He, the Mortgage Bankers Association's vice president, expects mortgage rates to fall back into the 5% range as tight inventory eases up, but when that exactly happens will depend on how the central bank opts to adjust policy over the coming months. AKA, the Mortgage Bankers Association says that things will fix in the housing market when we see mortgage rates fall to 5%, which will happen as the inventory kind of loosens up a little bit, which is a very interesting thing to say considering interest rates have risen so significantly because the Federal Reserve Bank has been forced to hike up interest rates because of high inflation. So now they're saying that the interest rates or the mortgage rates are going to fall because, well, the housing market is struggling. However, the reason why interest rates have gone up so much is because the Fed has been forced to raise interest rates because things like the housing market have gone up so fast. So the Fed is stuck in a situation where they're working to raise interest rates because the home housing market has been growing. They're being forced to raise interest rates because inflation is so high and inflation has not come down. And they're going to have to continue staying aggressive with interest rates so long as inflation is still high and is still around. And this is where we have a lot of predictions by the Mortgage Bankers Association that mortgage rates are going to fall as soon as the end of 2023. But what's interesting, if we start to look at history, this is a chart from the Federal Reserve Bank which shows federal funds rates compared to mortgage rates. Now, the federal funds rate is the rate that the Federal Reserve Bank sets. Think of it like the wholesale rate that banks get to borrow money at. And what you'll see, if we extend this for the longest period possible, there's only a few periods where the mortgage rate fell below the federal funds rate. The last time we saw this happen was in the early 1980s when we were going through a recession, the 1981-1982 recession. But besides that, it is very rare for mortgage rates to fall below the federal funds rate. So what does that mean? Right now, today, we are seeing the federal funds rate in the 5% some range. In order for mortgage rates to fall to the low 5%, that would mean either A, the Fed starts cutting interest rates very soon or right now, or B, we see mortgage rates fall below the federal funds rate. Now, talking about A first, the Federal Reserve Bank cutting mortgage rates, that isn't very likely right now because number one, inflation is still strong, and number two, we haven't seen that pain in the economy yet. Now, of course, you can argue we're already in a recession. You can argue there's pain in the economy, which there is, but unemployment is still very low. And so it's a very tough ask for the Fed to start cutting interest rates, especially significantly now, because, well, they just don't have the justification yet, especially with inflation where it is right now. Does that mean that the Fed will agree with me? No, but based off of the data that we have right now, it's very unlikely that the Fed's going to start cutting interest rates right now unless they just decide to make a complete pivot. Then option two is, well, if we want to see mortgage rates fall back down to the 5% range, which is what the Mortgage Bankers Association is saying, that would mean the alternative is mortgage rates have to fall below the federal funds rate. Now, again, what is the federal funds rate? The federal funds rate is the rate at which banks get to borrow money at. And then they jack up this interest rate and then they charge you the mortgage rate, the retail rate. So if banks are going to lose money on every mortgage, then that could happen. And it has happened occasionally in the past, but not sustainably, because that would mean the banks are losing money unless they have some special subsidiaries or some special grants or some special programs from the government to incentivize them to do that. Otherwise, it is going to be very unlikely for a bank to make a loan lower than what they have to borrow money at. I mean, you could just look at the Federal Reserve Bank chart versus the mortgage rate chart. It doesn't really happen. So now when you have the Mortgage Bankers Association coming out saying, don't worry, mortgage rates are going to fall back down to the low 5% soon, based off of what? Based off of the fact that mortgage rates are high, based off of the fact that the housing market is unaffordable. It doesn't really make any sense. It doesn't really go off of anything that we've seen in history because, well, the numbers tell us that banks pay money to borrow money. That's the federal funds rate. And then, just like any other business, they jack this price up and charge you the retail price. So if banks have to pay a certain price, the federal funds rate, and then you pay the mortgage rate, generally, unless there's an exception, like we've seen occasionally, rarely throughout history, the last time we've seen this was over 40 years ago, the banks are going to charge you a higher rate than the federal funds rate, which means for the bank to charge you 5% on a mortgage, the federal funds rate has to be less than 5%, which would mean that the Fed would have to start cutting interest rates, which would mean that the Fed would need fuel to start cutting interest rates, which would mean that you'd have to see a lot more pain in the economy. Or you'd have to see inflation significantly fall back down quickly. Because if the Fed starts to cut interest rates tomorrow, what's going to happen? Let's just think about this hypothetically. If the Fed were to cut mortgage rates to 5% tomorrow, what's going to happen? Well, you're going to see a flood of buyers hit the housing market because people want to buy a home. And so now if you see a flood of buyers hit the housing market and you still have a limited supply of homes for sale, home prices are going to go up through the roof. Why? Because people will want to take advantage of the low mortgage rates. What is that going to do? Well, let's think about this now. Inflation, measured by CPI, has about 40 to 44% of its factors related to the housing market. So if home prices were to shoot up, the CPI numbers would also shoot up. If the CPI numbers or inflation numbers shoot up, that essentially means that the Fed would be losing its fight on inflation because that means inflation is higher. So that is a very tough predicament that the Federal Reserve Bank is in, because on one hand, if they started cutting interest rates, sure, it will make getting a mortgage more affordable, but you forget that the opposite side of that is that home prices will go up even faster, which means people would have to borrow more money, which is kind of how we got into this situation in the first place. You can't fix an inflation problem by creating more inflation. And this is where now, of course, the Mortgage Bankers Association has their own agenda. They want to make sure the bankers feel safe, the bankers aren't panicking, the bankers are still lending, that they're still strong and feeling okay, that they're feeling supported. But the reality is something a little bit different. And this is where now history is important to look at, because while history doesn't necessarily repeat itself, it does rhyme. And you can take a look at what the Federal Reserve Bank has done in the past. You can take a look at what federal funds rates mean in the past. You can take a look at what mortgage rates mean in the past. And to hear bankers and the Bankers Association essentially saying that mortgage rates are going to fall to 5% to help heal the housing market, it takes a little bit more data than that to really understand how that's going to make any sense. And this is why I want you, as a financially educated person, to, one, understand what's going on, but then second, make your own decisions. I'm not saying blindly trust me. I'm just a random guy on YouTube. But what I'm saying is understand what's happening and don't just blindly listen to headlines, because headlines can say anything. That mortgage rates are going to fall to 5% by the end of the year. How? Why? Ask questions. That is what a financially educated person does, instead of just believing whatever's on the internet. And so this is where now understanding what impacts mortgage rates, what impacts the housing market, what impacts money. That way you can take better care of yourself, your family, and your community. Because the reality is, well, we're going to see a lot of changes happen in our economy. Not just the housing market, but our economy. Because the reality is, these higher interest rates are going to have an impact. We have yet to see that impact. And we're going to see it in the coming 12 to 18 months. Because the higher interest rates came very quickly. And these higher interest rates are going to cause pain in many different sectors of the economy. We haven't seen that happen yet. And this is where now you want to be a financially astute investor. Be prepared, meaning have cash put aside to take advantage of opportunities, but also be financially educated to be able to see the opportunities. That way you can take advantage of whatever opportunities might come your way. But this is where now you want to be the person that's cutting through the headlines. That's one of the goals at Market Briefs, is to avoid all the sensationalism, because all of our news is in one email. So cut through the noise, be educated to identify the opportunities, but then also be prepared to capitalize on the opportunities, meaning have the money to be able to buy the opportunities. That way you can win in this economic system. The housing market is on choppy waters, not just because of home prices and mortgage rates, but because banks are struggling to make money. I'll show you. It's pretty obvious that we still have a low inventory of homes available for sale, which are still keeping the prices of homes high. So even with the higher mortgage rates, either you pay the higher price or you don't get a home. But if we shift gears